Okay, welcome. Got a video here. SPIVA, S&P indices versus active. I've done videos like this before. New data has come out. It came out a while ago. The new data doesn't really change much. So it's not the data that's driving the video. It's just that the topic is so important that I'm going to always do updates on this. So here we are, SPIVA. What does SPIVA stand for? S&P indices versus active. So SPIVA provides the data that proves active fund managers as a group are harmful to your financial health. As a group, active fund managers do not add value. They underperform their index. So that's what SPIVA is all about. We're going to look at the latest report and I'll show you the magnitude of how they underperform. Now this, the easiest pickup of 2 full percentage points on return without increasing risk is for those who move from actively managed funds offered through a financial advisor to doing it themselves and investing in low-cost, broad market, passively managed investment products, likely ETFs. They reduce their cost factor from roughly 2% in Canada. I'm not sure what it would be in the US, probably lower, but probably not that much lower. In Canada, if you have an advisor and they put you into actively managed funds, the funds are going to charge somewhere around 2%, or your portfolio will cost somewhere around 2%. And I don't really know what that number would be in the US. So if you can reduce that and build your own portfolio, you can save 2 full percentage points. There is not an easier way to gain 2 full percentage points on your after cost return than this. Now, the problem is, who uses financial advisors? Those who are inexperienced with financial planning matters and investment matters, and those who are simply uninterested in financial planning matters and investment matters, and they are more than happy to hire someone to do the work. Now my point, the whole point about BIOFA, BIOFA.com, www.biofa.com teaches the uninterested and inexperienced how simple it is to be their own financial advisor. You need no investment expertise whatsoever. You need a little bit of financial planning knowledge, which is simple to learn. And that's what BIOFA is all about at biofa.com. Now, how financial planning is extremely simple. This is especially true if you are an employee and your spouse is an employee and neither of you are in the executive suite. So neither of you are CEOs making $2 million a year. You might be making up to $400,000. You might be making as little as $30,000. If that is your income and it's employment income, there is only so much financial planning you can do. There aren't any tricks that a financial advisor can tell you about that exist that you don't know about that will change your life. They just don't exist. There's a few basic things you do, and if you get those right, that's about all you can do. That's why, financial advisors add value. There's no doubt about it, because they know this stuff that you might not know. However, the benefit of hiring a financial advisor is not anywhere near the cost of paying a financial advisor, because you're not just paying the financial advisor. You're paying all the hands involved, and there's a lot of hands involved. So spend a half a day learning the basics, fire your financial advisor, and you can grow your after cost rate of return by 2 full percentage points. Okay, so let's get into SPIVA. SPIVA is, it provides the data that shows that active managers underperform. They constantly, continually underperform. So I've done these videos before. We just have another 6 months worth of data. It doesn't really matter. I look at the longest term data. Here is the report. This is as of June 2020, I think. Okay, so here, this is the first thing we'll look at. Continued long-term underperformance of Canadian funds. So if you look over here, percent of active managers underperforming. Canadian equity. So a Canadian equity fund versus a Canadian equity benchmark like the S&P TSX Composite. 89% of fund managers over a 10-year period underperformed. U.S. equity, 95% of managers of U.S. equity funds offered to Canadian investors underperformed over a 10-year period. Global equity, 94% underperformed. International equity, 85% underperformed. Okay, so let's go look at the magnitude of the underperformance. Mid-year 2020 SPIVA report. You can get this report here. Okay, asset-weighted fund returns. The S&P TSX Composite 10-year annualized return to June 30th, 2020. So June 30th, 2010 to June 30th, 2020. The index grew at a rate of 6.35. The asset-weighted fund returns was 4.93. This means the average investor invested in a Canadian equity mutual fund received 4.93%. S&P 500, 16.85. The average Canadian investor investing in a U.S. equity fund offered to Canadian investors 14.05. So they underperformed by more than 2 full percentage points. International equity, 8.95. Is the benchmark. 7.07 is what the average investor got. Global equity, 13.21 is the benchmark. 9.89 is what the average investor got. Now, look, what is the reason for this? You can't really blame the fund managers. It is the cost. It's too hard to overcome the cost. At the beginning of the year, they are already in the hole by the amount of the cost. So they have to outperform that hurdle of the cost. So, in Canada, you go to a bank, you go to one of the big 6 banks, and right now I'm going to pick on TD mutual funds. You get something like this. So you go to a bank, you say, I've got some money, I want to invest, I want to save $1,000 a month. What should I put it in? They'll run you through a whole bunch of financial planning concepts and calculators, and you'll have a conversation, and they might throw you in something like this. TD Comfort Balanced Growth Portfolio. In this fund, there is $7.5 billion of investors' money. Here's the big number. This is all you need to know. The cost is 2.03 percentage points. So what does that mean? So here's the fund. TD Comfort Balanced Growth. There's the current price. Here's the cost, 2.03. It's called the management expense ratio. Assets, $7.5 billion of client money in the fund. Okay, here's the bench. Actually, they don't really. I'll show the benchmark down below. Actually, I'll show the benchmark now. Here is the portfolio breakdown. This is kind of how the portfolio looks. This is almost like their benchmark. Bonds, 27%, international equity, 22%, foreign bonds, 10%, income trust units, 50%, US equity, 22%, Canadian equity, 15%, and other. Okay, so here's how the cost works. Here's a 10-year number. This fund looks like it was, the inception was somewhere in 2008. So the last 10 years, if you were an investor in this product, you would have received an average annual rate of return of 5.2%. If that 2.03% cost number was 0 instead of 2.03, you would have received an average annual rate of return of 5.2 plus 2.03, which is 7.23. In other words, if you do a little bit of the math, the fee, the cost to invest in this product removed 28% of the annual rate of return. So you didn't get 7.23, you got 5.2. That is a 28% cost haircut. That's the problem with these things. They might have great intentions. It's not, the only thing that makes this a bad product is this number right here. Because you can build your own portfolio with a very similar asset allocation to this for probably under 10 basis points. So that's 1/10 of 1%. And if not under 10 basis points, maybe it's as high as 12 basis points. It is a fraction of the cost of this. So that's all I wanted to say. The easiest pickup in return, do it again, without increasing your risk profile, is to fire your financial advisor and save the full 2 percentage points. Let that compound over a lifetime, and the difference is enormous over a lifetime. So I hope you enjoyed that. Thank you.